After a strong first half of the year, global dairy markets have lost some steam. Prices have eased across the major exporting regions, even as milk production continues to grow. At the same time, weather risks, animal diseases, and changing buying patterns are creating uncertainty for the months ahead. Joining me today is StoneX Director of Dairy Market Insight, Nate Donnay, to break down what's driving the market, where supply and demand are heading, and the key risks to watch through the second half of the year. Thanks for joining us, Nate.
Thanks for having me again, Fiona.
So, Nate, the market has shifted quite quickly from strong prices in Q1 and Q2 to weaker prices in June. What's driving this correction, and is it more about demand than supply?
Well, some of the blame falls on the supply side. Milk production is continuing to grow across the major dairy exporters. The US production was up 3.9% from a year ago in May once you adjust for the higher components in the milk. New Zealand was up 5% in May. EU 27 and the UK were up about 3.2% on a solids adjusted basis in May. This is a market where the supply side typically grows around 1.5 to 2%, and that's usually enough to meet the demand growth. So when we're talking about 3, 4, and 5% growth numbers, there's still above average supply growth out there. But honestly, I think most of the blame falls on the demand side. We've been dealing with this strong milk production growth for a while, and the strong production growth did push prices lower in the second half of 2025. Those lower prices brought buyers off the sidelines, and they've loaded up on product. And that strong demand during late 2025 into early 2026 has pushed these prices higher again. And now these buyers have stepped away from the market, and with production still growing, the prices are slipping lower here during June.
So, as you mentioned, milk production is still growing across the US, Europe, and New Zealand, but you're seeing signs that growth is beginning to slow. What are the biggest factors that could limit production in the second half of the year?
Yeah, while production is still growing faster than normal, the growth rate has slowed down. Across the major dairy exporters, growth was about 5.5% during the fourth quarter, but that slipped to about 3.5% during May. For one thing, we're lapping over big gains last year, and it's tough to put additional big gains on top of big gains last year. Second, there's a lag between changes in commodity prices and when those eventually show up in the price of milk. And then it takes farmers a little bit of time to respond to the changes in the milk price. So the collapse in dairy product prices in the second half of 2025 is now starting to impact production decisions on the farm. Um, so it's a combination of lapping over strong growth last year, as well as farmers reacting to milk prices and margins that are lower than where we were last year.
And one of the more interesting points in your report is how dairy farm economics have evolved, particularly in the US. How important has additional income from dairy beef crossbred calves become? And what does that mean for milk production incentives?
The dairy farmers around the world are benefiting from high or record high slaughter prices for their older cows. It's driven by the very high price of beef. But US farmers have been getting an additional boost because they've shifted to crossbreeding their cows with beef in recent years. In 2018, about 7% of US dairy farm revenue came from slaughter cows and calves. Right now, I think that's closer to 20 to 25% of a US dairy farmer's revenue is coming from the slaughter cows and calves if they're a Holstein farm that's crossbreeding half of their cows to beef. So US farmers are very profitable compared to the rest of the world. And even with milk prices falling here during the third quarter, that profitability is going to stay strong.
And then on the demand side, China remains relatively subdued while the rest of the world has been driving import growth. How do you see global demand evolving through the third quarter? And what would it take to bring buyers back into the market?
Global imports reached record highs through April. We've been trending parabolically higher on global imports. And I think a big part of it is in response to the low prices that we saw in late 2025. China is the largest importer. They take about 20% of globally traded dairy products, but they haven't been the big driver in this import strength. It's really been the mid-sized and smaller importing countries who are more sensitive to pricing. Those buyers now have enough product on hand that they can be a little bit more choosy with the prices that they accept. And right now, I think we're going to see a little softer demand for the third quarter. To bring those buyers back into the market, I think there's two different triggers. The first would be dairy prices falling low enough that the prices are just too attractive to pass up. And we might see that for butter and cheese, where there's quite a bit of weakness right now across the major exporters, but particularly in Europe and the US. On the powder side, I'm not sure the skim milk powder prices are going to drop low enough to really entice buyers to step back in. Um, so then the second thing that might trigger more aggressive buying would be fears about supply growth slowing even further. And I think the primary concern there would either be El Nino um, or health related issues like New World screwworm in the US, blue tongue, or bird flu could cause enough concern on the buy side to bring these buyers back into the market in the third quarter.
And then bringing it all together, you've outlined both bullish and bearish factors, from strong protein demand and weather risks to ample milk supplies and heavy European inventories. As we head into the second half of the year, which risks do you think the market is underestimating the most?
It's a tough question. If you just said, what are the bullish risks and bearish risks, it would be an easier one to answer. I'm not sure that the market recognizes how truly good global import demand has been over the past year. When I show people the data, they're pretty surprised by it. And this could be a bullish or a bearish risk for the market. If a big chunk of the import growth over the past year is actual consumption, and not just inventory buildup, it could be a bullish driver for the market if demand is better than everybody thinks on the second half of this year. However, if a lot of the imports went into inventory in the importing countries, then demand is going to be probably weaker than expected in the second half of 2026. But in general, on the bullish side, we still have very strong demand for the high protein dairy products, which could lift up pricing for all of the dairy products that contain protein. We still have weather risks, primarily around El Nino, and then animal health risks that are bullish for the market. On the bearish side, strong milk production, heavy inventories, particularly of butter in Europe, and buyers currently look like they have enough product on hand. So we're seeing some of this downward pressure on the market here short term.
Well, thank you very much for your insights once again, Nate.
Thank you.
For more videos like this, please do like and subscribe.